A couple videos ago, we talked about owner's distribution and what happens when owners take money out of the business and where it goes on the financial statements. I'll give you a quick summary of that video, and basically the owner's distributions or owner's draws come out of the business and they show up in the equity section. So you'll be able to find that information there. It won't be on your profit and loss statement. However, that video is full of great information, has a lot of good information that has been helpful to people, and I've been getting lots of comments on it. So definitely go and check that out. We'll be sure to put it up here so you can find a quick link to that. This video is kind of a follow-up to that one, and it's going to talk about some best practices in recording those owner's draws and distributions. We're going to look at the equity section and show kind of some best practices on how to name your accounts. And then I'm also going to show you how to close out equity at the end of the year so that you can start with a fresh equity section every single year, and it will give you a lot of clarity so you can always know how much you've taken in draws throughout the year. Okay, so if that sounds good, please stay tuned. If you aren't already subscribed to the channel, I would love to have you here. We are on a mission to help business owners understand their financials in order for them to make better financial decisions and create more wealth for their business and also for themselves. So if that sounds good, we'd love to have you here. Let's go ahead and talk about equity. The equity section in the balance sheet is the most confusing for a lot of people. Assets seem to make sense, liabilities seem to make sense, but when it gets down to equity, it's a little bit confusing as to why it's there and what is supposed to show up there. And it does kind of just cause a little bit of concern. And usually that's where I lose business owners when they're looking at their balance sheet. So what is in the equity section is really all about how money has come into the business over time, whether that was coming in from investors into the business or if money was coming into the business from profits and earnings from the business. And that equity section will tell you a lot about the health of the business and how it's been operating over the years by just being able to look at that if you know what you're looking for. Okay, so some of the common things that you're going to see in an owner's equity or a shareholder's equity section will be things like owner's investments, owner's distributions, retained earnings, and the current year's net income. So you'll be able to see all of those things. And this is for entities that are not issuing stock like C corporations that have preferred stock and common stock when they're issuing it to lots of different owners. Okay, this is mostly for your sole proprietors, your LLCs, your partnerships, and your S corps. Okay, so those are the common things you're going to see in the equity section. I'm going to break down what each one of those things are real quick so you can get familiar with what should be there. The first thing is owner investment. So this just really means anytime the owner uses their personal funds to bring it into the business, it gets recorded there in owner's equity or owner's investment. Sometimes owners will loan money to the business that will be repaid, and that would be in a liability section instead. But this is money that the owner has just said, hey, this is going to fund the business. I'm not looking to get it paid out directly. I just am looking to invest this money. So oftentimes you'll see this at the very start of a business. An owner will put their own money into the business, and then that will kind of get the ball rolling for the business, and it will be kind of the foundation of the equity in the business. Okay, so owner's investment, pretty straightforward. Owner's distribution is the opposite. So that's when owners are taking money out of the business and taking it into their personal finance, over into their personal lives, okay? Retained earnings. So retained earnings is earnings in the business. And when I say earnings, I mean money kind of net after distributions, okay? So profit comes into the business and then the owner might take out some money to either pay taxes or pay themselves. The net of that is retained earnings, and that's going to be from previous years. So retained earnings will only kind of represent past earnings, and that'll be cumulative for basically everything that's happened in the past in the business. If the business started in 1990, that retained earnings number will be cumulative from everything that the business has taken in over the years, okay? Then the last thing is net income, and that represents your current earnings for the current year. At the end of every year, you close out your net income and your owner's distribution into retained earnings. So what's left over of all the net income that comes in and then minus the distributions going out, that leftover number gets closed out to retained earnings. And so that'll usually be a smaller number than whatever the profit number was. And so every year, the idea is that you're sort of building the business and keeping more and more money in. And that will show up in different ways. That money will either be sitting in your bank account, or maybe it went to buy assets in the business. It can show up in lots of different ways. So I would recommend checking out our financial review videos, where we actually dissect and look at the profit and loss and balance sheets of real companies, because those can be really helpful. What I'm going to do now, though, is I'm going to show you what it looks like to, I'm going to show you an example of some of those accounts, how you can set up your own equity section. And then I'm going to show you how you can close out the equity every year at the end of the year. Okay, so let's get into a screen share, and I'm going to walk you through that real quick. All right, so I've taken a couple screenshots here, and I have put them into this Excel spreadsheet just so we can do a little bit of math on the side. But here is an example of an equity section. This is that very simple example I was talking about. These are some common things you will see in an equity section. Now, up here at the top, you'll see opening balance equity. That is essentially, for this business, that was the same thing as the owner's initial investment into the business. That's what the owner put in. And we've got a couple other accounts here. Owner's distribution, we've actually broken it out into two categories. And this is what I would recommend for everybody, is to have your owner's distribution, which is just your regular, whatever you're taking out, if it's quarterly draws, if it's monthly draws, this is that part of the compensation you might be having. But to actually separate that out and separate owner's distribution taxes as a separate line item. We're going to have another video here pretty soon talking about planning for taxes and how you're supposed to deal with taxes, and which taxes show up here in the equity section and which taxes are actually showing up on your P&L. So that should be a good one. Make sure you are subscribed to the channel so you can learn about that. Now, retained earnings is the other one that we talked about, and then current year net income. So this is your equity section. Okay, I want to show you guys what it looks like. This is a real equity balance for a real company. And this is before we've done the year-end journal entry to close out. That term close out, meaning to make zero, to restart, to close out the equity section so that in the owner's distribution, so that we can start afresh the next year. So in this case, this business had owner's distributions of just over $100,000 to the owner. And then the owner took out another $32,000 to pay for taxes throughout the year. And the business did make $182,000 during the year in profits. So, just very quickly, you can see that there is a little bit, this business will be leaving. This is how I think about this. I'm going to just type this in real quick. This is your net income. This is owner's distribution. Two different types of owner's distributions. So net left over, the business made $182,000. The owner distributed $136,000. And so what was left over, which will close out to retained earnings and add to the retained earnings balance, is $45,868. So I'm going to show you guys what we want to do. And the reason we close it out too, I see sometimes some bookkeepers will not do this and they'll just let this number build over the years. And I've seen this owner's distribution number in the millions, but retained earnings is also in the millions. And then a business owner will look at their balance sheet and they'll go, there's no way I've taken millions of dollars out of this business. But the truth is, when it's cumulative and you've owned a business for a really long time, yeah, you probably have taken over $1 million out in distribution. So I like that the retained earnings number stays true to really what is relevant to the actual assets in the business right now. And you can also see when you close it out every year, you can take a quick snapshot of your balance sheet during the year and get a real sense of how much you've taken so far this year. When you look at that huge cumulative number, it really isn't giving you very good information. Okay, so we always want to close out the owner's distribution to retained earnings every year. So here's what that closing entry will look like. So we're going to, owner's distribution is negative equity. So we have to counterbalance that and make it a credit. So we're crediting out the balance of the owner's distribution to make it zero. And then we're closing out that number to the opposite balancing side. This is a journal entry. and we are booking it to retained earnings. So the sum of these two is 136. Whenever you book a journal entry, your system will not let you post it if it does not balance. So debits have to balance the credit side. And if you guys want some content on how to do journal entries, you let me know, because I've been thinking about it and I'm just not sure how much you guys want to get into the nitty-gritty of accounting, of like this part of accounting. So, but this is kind of your double entry bookkeeping. There's always the balance of debits and credits, and this is how you can close out the account. So after we do that, we make this closing entry on January 1st of the current year in order to start afresh at the beginning of the year. Once we make that, this is what our equity will look like afterwards. So you can see owner's distribution restarts to 0 in both the regular owner's distribution and owner's distribution tax accounts. And you'll see that our retained earnings number has now increased to $95,000. And that is the difference between the existing retained earnings of 49 and then that added 45. I've done the math down here so you can see it. Let's make this a little bit bigger for you guys. So here's prior year earnings, prior year retained earnings, plus your earnings from 2023 minus your distributions for the year get you to that remaining retained earnings number. Okay? So everybody should be doing this in your books every year. If your bookkeeper is not doing this for you, I would like you to send them this video and say, hey, Hannah mentioned something really interesting. I would like to be able to see my distributions every year really clearly just for what I've taken during the year. And I'd like my distributions closed out to retained earnings. This is what I mean. And they will get it very quickly. So sometimes it's just a preference thing, and really equity can be overlooked a lot of times by owners and by bookkeepers because it's not kind of in the, most of our transactions are hitting the profit and loss statement or our assets and our liabilities. And sometimes equity is just kind of forgotten by people. So that's okay. I'm bringing awareness to you, and this is going to make your financial statements look a lot healthier, and they're going to be a lot clearer to understand. Okay, well, those are some best practices for you when you go to think about how you record your owner's distributions and what you need to do to close out your equity every year. All right, well, thank you guys so much. If you have any questions, please put them in the comment section below, and make sure that you like this video if it was helpful to you, and we'll see you soon. All right, bye everybody.